I think people get really confused around all of these topics. People confuse inflation and debasement for starters. So inflation is the rate of increase in prices, and debasement is the devaluation of the purchasing power of a currency. What most people are observing is debasement. Generally, we've been observing that doesn't affect the bond market. Does the US go into default? No. Does it increase the headline rate of inflation? No. The rate of inflation goes up because of what's just happened with supply chains, or in the 2000s, it was because of China coming on the market as a demand shock. That's what really changed inflation, because structurally we've got this aging population and high debt. So you tend to get lower inflation over time. So I don't think it's a bond market bubble. It is a financialization bubble, i.e. a debt bubble. But I think that drives interest rates lower, not higher. Because what happens is you lower the trend rate of growth of the economy because of debt. So each dollar of debt you take out, the less increase in GDP you get for it. So that's an over-leveraged economy with a bunch of old people. You can't generate that kind of thing. You can't generate that kind of growth. So I don't think that we're in a bond market bubble. I think we're in a debt bubble. That's a different thing. You know, is the US going to default on its debts? Well, they're going to do it not by not paying them. They're going to do it by debasing the currency, which is a whole different issue. So I don't agree with Dan. I don't think that the bond market becomes unhinged because the central bank just buys it and they just lower the value of their own currency. So Japan has been doing that. Japan has been buying its bond market to stop yields going too high, and what happens is the yen collapses.
What about another piece of the puzzle here is, why is the dollar so strong these days? Can you fill us in on that?
So the dollar is a game of musical chairs. It is a world massively in debt in dollar terms. Most trade is done in dollars. So most borrowings are done in dollars. In fact, most of the world's lending is done by the euro-dollar market, which is the offshore dollar lending market, generally driven by the European banks, the Japanese banks, and some of the Asian banks. It's a game of musical chairs because the moment that growth slows down or growth is too fast, generally it's when growth slows down. When growth slows down, people need dollar financing. And there's less dollars in the system. If the Fed are withdrawing liquidity right now, there's less dollars. So you're taking a few chairs away. First one was Sri Lanka. They're like, where's my chair? Gone. Right? And you'll see one country after another. We're now seeing China starting to devalue its currency. It's because part of their chair's been taken away. You know, one of the chairs has been taken out of the room. So that's what happens, is there's too much dollar borrowings. And in a slowdown, people need more debt. And there's not enough debt being given out because the Fed are taking supply out of the market. In the other side, the dollar goes up. The dollar's got a smile. So if the world is growing, generally the US has been the kind of leading world economy in terms of where you want to put your capital. So in a growing world, the dollar tends to do pretty well. The dollar does very well in a slow world. The dollar does terribly in a kind of muddle through reasonable growth world.
That is true, of course, because, you know, so much of the worldwide debt is denominated in dollars because the dollar has the world's reserve currency status. When these cycles play out, does that tend to can that erode the position of the dollar over the kind of the longer term time horizon, or how do you see that playing out? Does this sort of, you know, shock to the system diminish the dollar's long-term power?
It actually rebalances the system decently, right? It's the shock absorber. Because if the dollar goes up, it stops other nations' excess borrowings of dollars, so it reduces the liabilities in dollars. Now, you might have defaults to deal with, but it does that. It also slows down inflation because the dollar itself is the denominator of all commodity prices. So if the denominator's going up, then the price of the commodity goes down. So it actually works as a balancing effect in many respects. The flip side is people like China and Europe get pissed off with it because everybody's a function of the US liquidity. And the dollar is used as therefore an economic weapon that's not in anybody's control, which is why both China, Europe and others have started to try and push back on the dominance of the dollar. The dollar is so incredibly dominant. It's like 80% of world trade is in dollars. And they want it back to a more reasonable level that better represents the size of the US economy in the global picture. So the US economy is what, 25% of the global economy, down from about 40% due to the rise of China and India and others. So the dollar should be 25% of global trade. Now, it's the reserve currency, so maybe 50% would be the right number, but it's too much.